Hey, investing friends, if you're chasing monthly income with covered called ETFs like ULTY, MSTY, and NVDY, you might think you're winning the distribution game. But today, I'm going to show you why these ETFs almost always underperform the stocks they're built on. We'll break down exactly how covered called ETFs work, use NVIDIA as a case study, and look at what it really costs to collect those juicy yields with an academic paper. Let's do this! If you're new to the channel, welcome. I'm Mr. Financial with over 100,000 followers on Blossom Social. I'm into evidence-based investing, using empirical data and studies. If that's your vibe, hit that follow button. I'd love to have you here. I've made a number of posts on Blossom Social on the topic of covered call ETFs, and one entitled High Yield, High Risk, Low Reward Pie Illusions created quite the stir for some passive income folks. To help you understand the risk-reward profile of covered call ETFs, let's start with the absolute basics. What is a covered call ETF? It's an ETF that holds a group of stocks, or even a single stock like NVIDIA, and then sells call options on those holdings. We need to take another step back and ask, what is a covered call? The seller of a call option gives someone else the right to buy a stock for a set price before a set date. If that option gets exercised by the buyer, the shares get called away or sold. In exchange for this right, the seller is paid what is called the option premium. It is called a covered call option when the person owns the shares they're selling a call on. Take a look at the NVIDIA option chain to get a better understanding. Here's the price to sell a call option on NVIDIA with a 26 DTE, or days to expiry, at a price of $190. We as the sellers would be getting paid $11.15 per share for this call option. Now, options are sold in lots. A lot is 100 shares. So that means if we were to sell one covered call, we would receive $1,115. Now, for a covered call ETF, it works exactly the same, except you're not paid out the call option premium exclusively. The ETF provider decides how much to pay out, whether or not the ETF makes that amount in option premium. Option premium is great, but there's a catch. If the stock price goes above the strike price of the call, the ETF's upside is capped. You don't get that extra growth. The fund manager's options are, that pun was not intended, they can roll that option out, which means buying back the option before expiry of December 12th in this case, and then selling a new one for the same strike price just further out in time. They can roll that option up, which means buying back the option, aka closing the option before expiry, and selling a new one for a higher price, say $205, but for the same expiry date. They can roll that option out and up, which means buying to close that option before the expiry and selling a new call option for a higher price and for a longer expiry date. One last option is to let the shares get called away. The fund manager can then buy more shares at a later date to recover the share count. So what do you get for holding a covered call ETF? Monthly distributions from the fund. What are you giving up? Most of the explosive upside, the growth of the value of the underlying company or companies in the ETF. Depending on how out of the money the call option is, will be how much that upside is limited, but also the option premium you will make. And with a volatile stock like NVIDIA, that trade-off is huge. Let's look at an example using the high-yield ETF NVDY. Part of the YieldMax family of ETFs, and it uses synthetic calls. That means it doesn't really own the NVIDIA stock directly. Instead, it uses call option contracts to generate yield. Said another way, you're getting the option premium side of NVIDIA, but you're not riding the full wave of the stock's growth. Let's do a little performance backtest to compare NVIDIA and NVIDIA since it was launched. NVIDIA started trading in May of 2023. Since then, NVIDIA stock has exploded. We're talking 520% return since then. Now, people look at the double-digit, near triple-digit yield on NVIDIA and think they're winning. But when you factor in the missed capital gains, the story flips upside down. You're stuck with crumbs while the real party's happening in the underlying stock. Using totalrealreturns.com, we can see holding NVIDIA means losing out on half. You heard that right. Half of the total return, all the while carrying the full downside risk. Some say, well, if the fund is only selling on half the portfolio, they'll outperform the underlying, especially with leverage. Let's look at NVHE, Harvard's Enhanced Equity Income ETF, which writes calls on NVIDIA. NVHE was launched in August 2024, specifically designed to generate income from call premiums on NVIDIA with 25% leverage. Sounds great, right? But let's compare how NVHE and NVIDIA actually performed between August 2024 and November 14th, 2025, the time of the recording of this video. During that time, NVIDIA gained roughly 48.3%. It was on a tear. The USD also strengthened 3.8%, meaning the total return in Canadian was 52.1%. With 25% leverage to level the playing field, that's 65.1% in Canadian dollars. Meanwhile, NVHE returned 46% including its distributions, or 56.4% if all of its distributions were reinvested back into the ETF. The ETF missed out on 8.7% of the return. Let's dig deeper and look at the actual financial statement. According to NVHE's financial statement from August to December 2024, it had $282,000 in realized losses from writing calls and $66,000 in unrealized losses on open call options. That's a total of $348,000 lost due to their covered call strategy. Even though they collected premiums along the way, the net effect was negative. Why? Because the calls were likely exercised or rolled up and out as NVIDIA soared. So yes, you received monthly distributions, but the NAV of the ETF didn't rise nearly as much as the stock itself, and in this case was using a return of capital and capital gains to pay the distributions. NVHE is writing near to at-the-money calls, which are the highest yielding and the highest risk. How do we know that? Look at the financial statement. 95,300 shares of NVIDIA Corporation with a January 2025 expiry at $130. The lowest share price NVIDIA got to in December was $126.86, meaning it was 2.4% out of the money at most and likely at the money to receive the absolute highest option premium. Here's what many income investors miss. You're not just getting income. You're selling off your upside to get it right now while carrying the full downside risk of the underlying stock or index. And if that underlying stock tanks 30%, guess what? The covered call ETF of that stock will fall just as low. Let's say NVIDIA jumps 30% in a month. That month, NVIDIA sells calls that get exercised or time decay against the rally. And you don't see that 30% upside. Instead, you get maybe a 5% distribution yield and a small portion of that 30% upside. Plus, that distribution, option premiums are taxed as capital gains in Canada, unless you're holding it in a TFSA or RRSP. So now your monthly check is smaller than you think. And if it's a return of capital, that's just delaying the capital gains tax to a future, more painful date. So no, you're not getting rich by monthly distributions. You're kind of slowly getting milked by the ETF provider. This may sting a little to hear if covered call ETFs are the entirety of your portfolio. This isn't new information though. In academia, there are many papers on the cost of using a covered call strategy. The paper, A Devil's Bargain When Generating Income Undermines Investment Returns, Ronnie Israelov and David Nrong wrote this in their conclusion, and I quote, Instead, many appear to be enamored by the strategy's ability to deliver high derivative income. To the extent people associate high derivative income with high expected total returns, they've made a grave error. We demonstrate a strong negative mechanical relationship between covered call derivative income and its total return. We corroborate this mechanical relationship with a historical analysis of S&P 500 index covered call strategies. In light of the modeled mechanical relationship that is validated empirically, we believe it is nearly irrefutable that higher derivative income covered call strategies should be expected to deliver lower total returns. Covered calls implemented to deliver higher derivative income should be expected to have 1. Lower total returns, 2. Higher tax realizations along the path, and 3. A more negatively skewed return profile. Investors who allocate to these strategies for their income alone, without accounting for these other considerations, might have made a devil's bargain. I believe it's better to be informed now than decimated later when your portfolio is blowing up. Now look, I'm not here to bash on covered call ETFs. They're not scams. They have their place. They may make sense if you expect the stock or ETF to stay flat or move slightly up in the short term. They may make sense if you're willing to sell the stock at a target price. Say you own NVIDIA at $50 and you'd be happy to sell it at $190. You can write a covered call at the strike price of $190. If it hits it, you profit and collect the premium. It may also make sense if you want to generate a little bit of income from a large blue chip or an index with way out of the money calls to preserve as much of the upside as you possibly can. Covered calls may also make sense if you want to reduce your portfolio's volatility slightly by giving up some of that upside. So what are the key takeaways from this video? Covered call ETFs are not free money. They're trades that may or may not make money. Covered call ETFs like NVIDIA have capped gains and underperform NVIDIA by a lot. You're selling your upside in exchange for monthly distributions, not in addition to. In bull markets, that trade will almost always leave you behind the underlying stock or index. As the paper A Devil's Bargain put it, covered calls implemented to deliver higher derivative income should be expected to have 1. Lower total returns, 2. Higher tax realizations along the path, and 3. A more negatively skewed return profile. Yes, that yield isn't free. You're paying for it with opportunity cost and potentially NAV erosion that I don't get into in this video. So if you're buying a covered call ETF thinking you're getting the best of both worlds, cash now and compounding in the future, you are not. You're cashing in your future gains for a distribution today. Again, don't get me wrong. Covered call ETFs aren't scams. They're tools. But like any tool, you have to know when and how to use them. If you still want to use covered call ETFs in your portfolio after watching this video, check out my next one, where I'll go over what to look for in choosing a covered call ETF. Hope to see you there.